This is the tax planning that can save an agency do $500,000 plus in profit, over 6 figures in tax every single year. Now you might be thinking that sounds too good to be true, but here's what happens. Most agencies are stuck doing basic compliance that worked at 100K but will never work at 500K. They are missing a strategic element. And in this video, I'm going to show you 5 different strategies that you can use in your agency doing $500,000 plus to significantly reduce the amount of tax you pay. And by the way, this is all legal. My name is Rehan. I'm a chartered accountant and founder of Sidekick Accounting. Over the last 5 years, I've helped hundreds of agencies make more money and pay less tax. First, let's start with what happens to an agency when they hit £500,000 of profit. Suddenly, your 25% corporation tax becomes a huge expense, sometimes your biggest expense. That's before you've considered any personal taxes like income tax, dividend tax, and national insurance on you as the director and shareholder. The strategies that worked at 100K worked because you could very easily show a small amount of profit and pay yourself a relatively decent amount without paying much tax. But at this higher level of profit, you need to shift how you think about tax. It's more strategic, there are more opportunities, and if you do not act, it will cost you more than anything else in your business. First, let's start with the basics, how you pay yourself. Beyond a simple salary and dividend split, you need to think about your remuneration package as a director. If you're making $500,000 plus in profit, you're going to want to extract that so you can benefit your life, your family's life, and build wealth. But you don't want to do that while paying 50% plus in tax. What worked at 100K is take £12,570 as a salary, which is your personal tax-free amount, and take dividends up to £50,000. By doing this, you pay about £3,200 in tax, and you've extracted £50,000 of income. If you want to take more out after that $50,000, you'll end up paying dividend tax at a higher rate at 33.75%, and then eventually the additional rate. Now, as we all know, surviving in the UK off £50,000 today is very difficult, especially if you have a family. But it's also very difficult to get your head around paying almost 50% of your income to HMRC so that you can take enough out to live, not even build wealth and save money or benefit you. So what options do you have at this point? Well, when you're making a consistently high level of profit, you can start to support the people around you. You could hire your spouse in the business. Your spouse will also have a £50,000 basic rate that you can take advantage of. Now, they may be employed to support you in running the business. You can both take out £50,000. That means in total, your household income has increased to £100,000 without paying higher rates of tax. You may have teenage kids who can run your social media. Again, they can be employed by the business, they have their own allowances, and that will increase the household income without pushing anyone into a higher bracket of personal tax. You may even choose to employ your parents or your siblings to help out in the business for admin or anything else that they're skilled in. They too have their own basic rate and personal allowances that they can take advantage of, thereby increasing the amount of money you can extract from the company tax efficiently. Now, it goes without saying, everyone needs to have a legitimate job. They need an employment contract, they need to actually perform duties, and they need to be paid in line with what they are doing within the business. You can't hire someone in on 2 days a week and pay them £50,000 if that's not what the market rate is. You also need to make sure you are following the rules when it comes to employing young people. So this strategy works really well for high profit businesses where the owner wants to benefit their family, extract money, and do it very tax efficiently. Now, number 2 is a strategy that can get a cash refund of tax back into your business account that you can then use for whatever you want to. This is R&D tax credits, and at £500,000 plus of profit, you are probably already investing in things and innovation that will help you to qualify to claim R&D. If you're developing websites or apps, or you're solving complex technical problems for clients, you may qualify for R&D tax relief. The criteria here isn't are you a tech company, it's is what you're doing pushing the boundaries within the industry. Some examples of R&D claims that our clients have successfully put through and received tax refunds for are an influencer platform to help agencies source influencers. There's a food delivery platform that somebody did on the side that they've now claimed significant tax credits for in the form of R&D relief. And there's so many others when it comes to client work and building things for clients that are technologically demanding. And to put some numbers against it, say you're at £500,000 of profit and you're investing 20% in building things, your tax relief could be anywhere from £50,000 to £150,000 back into your bank account as a tax refund. It goes without saying, you need to track the spend that you are putting into this project. That includes team time and other expenses. A lot of agencies can do this retrospectively by looking through their accounting system and picking out the relevant costs. To actually make a claim, you want to make sure you've engaged an R&D expert, because this is a very technical area where a report needs to be submitted to HMRC along with supporting financial schedules. And if it's not watertight, HMRC can come back to reclaim that money from you in the future. Strategy number 3 is pension planning. Now, you may have contributed to a pension and you probably understand that making contributions from your company is very tax efficient. But here's a few advanced tactics that come into play when you are making significant profits. So you can contribute up to £60,000 a year into your pension, and that will qualify for all of the tax reliefs available. Now, what you can also do if you make significant profit in a tax year is go back and reclaim some unused allowances from the previous years. You can go back up to 3 years. So say you made a significant amount of profit this year, you could make a pension contribution, provided you hadn't contributed in previous years, of 60,000 times 3, so £240,000 into your pension in one tax year. If you did this, it would reduce your profits by the same amount, so 240,000, and at 25% of corp tax, that's saving you £60,000 in tax that you would have otherwise paid to HMRC. Another way to look at that is you put £240,000 into your pension pot, but it's actually only costing you £180,000. Another advanced pension planning strategy is a SAS pension. A SAS pension allows you to use your pension funds to invest in a wide range of assets, much more than a SIP or a traditional pension. Now, the asset classes include commercial property. So what you could do as an advanced piece of planning is make a large contribution into your SAS pension, which is now money that you own and control within the pension structure. That money can then be used to buy a commercial property, which may be the office that your agency operates out of, and then rent that property back to the agency. So the agency is paying rent into your pension scheme. That income in the pension is tax-free. The rent payment in the agency is a tax-deductible expense. So what you've effectively done is created a tax-free loop of money where your trading company is funding your retirement. Now, that's just one example of how advanced pension planning can save you a lot of money. However, there are tons of other opportunities to explore, and pensions are a great route to look at if you have any inkling of wanting to save for retirement. Strategy number 4 is quite simple, but it's often missed by a lot of agencies, and that's the timing of your income and expenditure. If you have a particularly good year and you're worried about the amount of tax you're going to end up paying, you may choose to delay starting work and invoicing a client until after your company year end. What that means is the income falls into next year, not this year, which in a worst case scenario means you've got an additional 12 months to pay that tax over to HMRC. But in a best case scenario, it might mean that by moving that revenue into next year, you've reduced profits enough this year to qualify for a lower rate of tax thanks to marginal relief, which means that you are saving tax, not just delaying it. The same applies for expenses. If your company year end is December and you know in January, February, you're gonna have a bunch of new starters, you're gonna need to buy laptops, you might be buying other assets for the company. You can choose to buy those this month instead, so the expenses are reflected in the current financial year, thereby reducing your profits this year. So timing expenses and when you make purchases can be a good play to help even out and smooth out your profits and when you pay tax. For larger businesses making large investments, timing plays an important factor in your annual investment allowance. That is the amount that you can claim in a year to reduce your profits by the same amount for qualifying assets. It's currently set at £1 million. So if you were going to spend £2 million on assets and you did it all in 1 year, you would not be able to claim tax relief for 50% or £1 million of your purchase. Whereas if you did £1 million this year and £1 million next year, you would then have full tax relief in both years. And the 5th strategy is your corporate structure. If you have grown and you are still operating out of a single limited company, the chances are you are shooting yourself in the foot because you do not have access to the advanced tax planning that something like a group structure would open up to you. A group structure means you have a holding company that owns the shares in various other companies. One of these would be your trading company, your agency. Other companies may be investment companies that hold property or other businesses that you've acquired or started. With this structure in place, your trading company can make profit and you can move that profit tax-free into the group and into another company, so you can start to move cash around and use it for investments that are separate to your trading business. Having multiple companies like this also means that you're benefiting from potentially lower tax rates in one company versus the other, access to different schemes, and even group loss relief, where if one company isn't making money and another is, you can transfer that trading loss over to the profit-making company to reduce that company's tax bill. This setup is super tax efficient, and where it gets even better is in the long term, there are inheritance tax benefits to this setup. And if you were ever to exit one of your businesses, you would be able to do this tax-free with the right planning in place versus paying personal capital gains tax that would happen if you had a single limited company that you were a shareholder of. This strategy alone can and has saved millions of pounds in tax on an exit. Now, it goes without saying, what we've spoken about in this video is advanced tax planning that does require professional advice and input. Nothing I have said here is generic advice that you should take away and implement before you speak to a qualified professional accountant or tax advisor. Now, if you want to speak to a qualified accountant and tax advisor, you can speak to me or a member of the team by booking a call using the link in the description. We can talk through these strategies and whether or not they can apply to you, and if so, how you can get them implemented. As always, if this was helpful, give it a thumbs up and subscribe to my channel for more tax saving tips.